Today, we're going to pull back the curtain on what really happens behind the scenes at Metropole. You're about to hear from Brett Warren, National Director of Property at Metropole, as we dive into the properties we've bought for our clients, the how, the why, and the outcomes. So welcome to another episode of the Michael Yardney podcast, where we help investors gain clarity amongst the confusion of the many mixed messages regarding the property markets so that they can develop the financial freedom they're looking for. But rather than just share case studies, Brett and I are going to discuss the meticulous planning, the in-depth research, the proven strategies that have helped everyday Australians develop financial freedom through property. So whether you're just wondering how to find the right property, you're curious about how professionals approach property planning, looking for some inspiration to take your properties to the next level, you're in the right place. So let's get started with today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
It's the beginning of a new year and a time when home buyers and investors are making their property plans for 2025. I know you've been busy at the beginning of the year of Metropole already with lots of clients already inquiring about what's going on. I think there are some great properties we've purchased over the last while I'd like to talk about as well.
Yeah, look, it has been busy, but busy is good, right? Because there's more people inquiring, and we're helping more people with their property journey. And I know you and I are passionate about helping property investors tread the right path. And that's exactly what we're going to talk about today, a little bit about how we do things, the systems, the strategies, the processes that we use. So I think it's going to be a little peek behind the curtains, making a bit of the invisible visible. And I think most people will be surprised just how much detail and information we get into. So looking forward to it.
Well, that's interesting because buying a property sounds easy. And I know a lot of buyers agents will find something for you straight away, but there's a lot of work that goes in at Metropole even before we talk about a property and about a location, from the initial research to having a strategy plan to finding and securing the right property. It takes some time. It's not as simple as some people think. But what makes it rewarding is when we see the results of the clients. You and I have been working together for almost 2 decades and we've been helping clients. So yes, I do want to lift the lid and share some of the secrets about what we do and how we've been able to achieve those successes.
Yeah, no, I'm looking forward to talking about this. Let's start to unpack. And I think it's a great time to do it at the start of the year. People are setting up New Year's resolutions. You know, just like when you go to a gym, you probably don't know where to start or what to do. So hopefully we can give people some valuable insights today. You know about that, don't you, Michael, at the gym?
Well, let's start with a disclaimer. While any property can be an investment, just kick the owner out and put a tenant in. Not every property is what we call an investment grade property, one that outperforms the averages in the long term, Brett.
Well, look, most investors, like you said, buy their investments close to where they live, or maybe they've inherited a home they've moved out on or something like that. There's been no real strategy there. I know a lot of people also come to us talking about buying a holiday home or maybe somewhere where they want to retire to. So it's probably not the best way to look at property investing. You know, you want to take a longer term approach. And the property you eventually purchase should be the manifestation of all that data and facts and information according to what you want to achieve. And that way, even then, you can start looking at the property.
Okay, so where do we start, Brett?
Well, I think it's a great idea to start with the end in mind. We don't start with the property. The first bit is to actually plan the journey out. And I know most buyers agents you go to, they're not going to really give you some, I guess, independent advice. If they're based in Melbourne, they're going to tell you to buy in Melbourne. If they're based in Perth, they're going to tell you to buy in Perth, despite where the market is. So having someone unbiased and having someone who can actually help you put a plan in place and understand your needs is really, really important. And what we do is we start with our clients' financial goals. We start with the end in mind. We understand what they want to achieve. We've got some very, very powerful software that we can actually then reverse engineer the whole process. They plug all their information in. They put their existing property portfolio in, their expenses, their savings, their incomes, their super contributions. And now we've got an amazing baseline. We've got a baseline of what would happen in 5, 10, 15 years if they did nothing else today. And there's a gap there. There's a gap between where they want to be and where they are now. And that then allows us to put a number of different scenarios and model a number of different scenarios to where they want to get to and where they want to do. We want to make sure we're doing this safely. We've got to have buffers in place. And that way we can start to progress. We can check in every 12 months. We can plan and prepare. And once we're comfortable with that, we're all on the same page, then we can consider looking at the property.
I guess the real benefit is they're able to grow their wealth faster and safer than the average investor. And a recent audit of the results of our clients, now a couple of years ago, showed they're 7.3 times more likely than the average Australian investor to own 6 or more properties. I guess they made the right decisions because they got the right advice. But I know the plans sound detailed, but they've got various subparts to them as well.
Definitely. And this is something that's really, really important. Most investors have a buy and hope strategy. They buy property and they hope they're going to get there. But we really factor it in. We start with the time frame. Again, if there's a 20-year time frame there, we need an accumulation stage at the start where you need to accumulate a number of assets. You need to get good, high quality assets in your portfolio. We've got a manufacturing capital growth. So we'd like to buy those kinds of assets that we can actually manufacture, we can add value, and you cannot actually do that with any other asset. So that first, I guess, 7 to 10 year period, if you're starting out, is a really critical time to make sure you've got the right properties. Make sure you get the right rental strategy. So by adding value, we're also increasing rent. We're buying in areas where there's an inherent shortage of rental properties anyway, so they keep rents quite strong. We've got to set your assets up properly. We've got to minimize tax and use that more efficiently. And then the back half, we've obviously got the finance side of things. We can start to look at paying off debt, removing debt from your portfolio. And then finally, the exit strategy, where we bring it all together. We talk about super, shares, property, any inheritances or savings, and how we can efficiently live off your portfolio at the end.
What that means is that you can outperform the averages, but it also stops you making mistakes. And this year, I'm sure there's going to be lots of negative messages in the media with an election coming up. And so if you've got a plan, you just stick to it and don't sidetrack. That's hard to do, of course. I'm sure some of our listeners and viewers are going to want to hear some case studies about actual properties we purchased. And I do want to get to that. But first, maybe you should explain what happens once our wealth planners deliver a written plan to our clients. How do we go about selecting where we buy or what we buy?
Yeah, good question. We don't just go to a location. We actually start with the budget. I often hear you say that property investing is a game of finance with a few properties thrown in. So the budget's not really, it's determined by the banks. It can be determined by the client, because we often get clients who don't want to spend their maximum. They want to be in their comfort level, in their comfort zone, which is absolutely fine. But, once we've got that budget, we've got to make sure they've got a buffer in place. We understand, different budgets are going to be located in different areas and have different finance limits. So that's kind of out of our control a little bit. But once we understand their capacity, then we can direct the location. We can look at the type of location we're going to buy in. And as we talk about, it's not something we compromise on. We generally stick to the East Coast, the bigger capital cities where there's a huge amount of demand and there's very, very, very little supply. And then finally, we drill it down a little bit further and we get into the right location and the right pocket within that area. There's so much research you can do. There's so many numbers and facts and data and detail that people often get analytical. And there's a lot of, technical data analysis that you look at that'll tell you where a hotspot's going to be or where the next property is going to boom. But in reality, even if you got that right after 12 months, you're really going to be no further ahead, particularly if it starts trending sideways. So we want more longer-term fundamental analysis, things that take decades to change to make sure we find the right property. And we use our 7-stranded approach, Michael. And I guess rather than me getting into that, you're the one who invented the 7-stranded approach, and maybe you can do that justice.
I will share it then, but before I do, just to highlight the point that you made, that a lot of people have done really well over the last couple of years by finding the hotspots. And there's a lot of buyers agents out there buying in the same locations because they're looking at the same data showing that certain cities in northern Queensland or Western Australia were undervalued. And now, since everybody, well, not unfortunately, it depends where you are in your buying journey, a lot of people have bought there and pushed property values above their fundamentals. And that'll create short-term growth, but you and I have been around long enough to see what happens after that. Even if the property market won't crash, it's not going to give them the ability to buy the next property. So part of our plan is to help people buy properties that help them buy the next property, not just to buy 1 or 2 properties, because that's, again, the intention to build a big asset base.
That's a good point. I often hear you say that. I often hear you say, people say, what property is right for me next? The next right property is the one that gets you into your next one the fastest. So that's a really good point.
Yeah, sure. So most of our clients are limited by budget. And so the only way they're going to get to the next level isn't with $20, $30, $40 more a week cash flow from a cash flow positive property. That's not going to be enough to give serviceability. They're also going to need to be able to get a deposit equity release to be able to get into another property. That's why most investors get stuck at one or two, because they haven't made the right sort of purchase that's going to work in the long term as opposed to the short term. So, yes, back to what the question you asked me. I'm sorry I sidetracked. We've got a strategic approach to finding a property once we find a location. And that location is based on research and on demographics and on looking for areas that have got locations where the demographics are earning more than the average for the state, and where it's gentrifying and new people are coming in, improving the location, where there's a large percentage of homeowners, owner-occupiers as opposed to investors, so that the location doesn't fluctuate as much when the market changes, because people don't sell up and give up their homes if they can avoid that. So we find the right location, and then within the location, we find a property below its intrinsic value. And that's why we avoid new and off-the-plan properties that come at a premium. And at the moment, as you mentioned before, in Melbourne, there's almost all apartments, almost all properties are below intrinsic value because they haven't gone up for 4 or 5 years. And that means that you couldn't replace them at the cost you're buying at. We look for areas, as I said, that have got a strong history of capital growth because of the demographics. We look for areas that have got the sort of property that's got, sorry, I said areas, but my mistake, it's actually properties, you asked me, that have got strong owner-occupier appeal. Not that we want to sell them, but we want the sort of property that other properties in the area are going to be bought by owner-occupiers that are going to push up the value of my property that we buy, or the property we buy for clients. So it's got to have owner-occupier appeal, but also scarcity. So not the Legoland apartments or houses and estates where they all look the same, or there's another estate next down the road that can be built, because the abundance of supply is the enemy of capital growth. And then we look for property which has got a high land to asset ratio. In other words, it doesn't mean you've got a lot of land, but the land value underneath is important because of its location. And you already mentioned we like properties with a twist that you can add value to something. So two separate things, I guess. A twist means it's got something special, unique, different, maybe a big courtyard, maybe a larger balcony, maybe a double garage. I know you and my strategy personally is to manufacture capital growth through refurbishment, renovations, development. And if that suits our clients, that's the sort of thing we look for as well. So again, we dig down when we look at a property, and there's really a shortage of good investment grade properties. So that surprises me when we hear of people on the social media who say, we just bought 10 properties in Townsville last month. There aren't 10 good investment grade properties. And this is not running down Townsville, but in Brisbane, it's hard to find that many.
Absolutely, yeah. I look, particularly in the right area and right location. I mean, you can go and buy properties anywhere. And I think you said before, just because you bought a property and you rent it out, it doesn't make it an investment grade property.
Well, let's have a talk about some of the sort of properties that we've bought based on that. Now, I know some of them have been off market. A lot of people are making a fuss about on the internet, hey, we got access to off market properties. The answer is, are they really, really off-market when people know about it? There's even websites that say off-market properties. Well, they're not if they're on the internet. So I guess they're really what I'd call pre-market opportunities, Brett, that the agent's aware of it. They know it's coming onto the market, but before they take the photos and do the plans and put it on the internet, they ring their A-class clients, and then they ring their B-class clients. And that's why we're on the short dial, the speed dial, the favourites of many estate agents, so we have access to those. But interestingly, while they do occur, and while we buy quite a number of those sort of properties, most of the ones we get offered, we wouldn't even consider, Brett.
Yeah, look, I think that the use of the word off-market opportunity is now a marketing tool, isn't it, Michael, really? And I think that some of the duds they try to pass off as off-market as a unique opportunity, and, it's not really like it used to be. And in reality, we're very lucky, I guess, because we network with these agents. We know them fairly well. By the time they've signed the listing, there's a couple of weeks to get photos and staging and things like that. That kind of gives us an opportunity to view. But there's also other people. There's also other competition, particularly in the hotter markets, if there are a number of buyers around. So it's quite rare to have less competition in these kinds of markets than we used to. True off market.
Oh, the world has changed completely. Relationships are important, though. Now that we understand that different budgets are going to mean different sort of properties, and I guess one of the thoughts before we even get to what sort of properties we bought is, should you buy one property for $1 million or two properties for $500,000 is often the question we're asked. And I know some buyers agents, just because of their fee structure, because they get a fixed fee, will buy two at $500,000 because it doubles their fee. Now, I'm not suggesting that they haven't got the client's interest at heart, but our suggestion is you should only buy quality properties. I know there's a very big organisation that says that they never buy in capital cities, but they also say they don't have a bias. Well, obviously they do if they don't buy in capital cities. So how do you decide what sort of budget? And then let's name a couple of budgets and the sort of properties the team have been buying.
Yeah, sure. So, look, I guess if you've got $1 million, you want to have one really, really good asset. I mean, we can buy two $500,000 properties. There's no problems with that. But it's not going to perform as well. It's not going to get you into the A-grade areas. Those seven-stranded approach with the land-to-asset ratios, the high affordability, they're the kind of markets and areas you want to get into. You don't want to get into secondary locations. I guess we're going to put a number on it. You want your money working at 7% per annum, not 5% per annum, because you've got two secondary properties and you paid two lots of stamp duties and two lots of fees to get in. And so, quality over quantity. But if we wind back to an entry level, look, we're seeing some really good opportunities around that kind of 5 to kind of 600 mark in Melbourne, 650 for villas, kind of north of the city. There's some really good opportunities there because there's not a lot of apartments being built in those areas, and they're not building villas anymore, Michael. And getting back to land to asset, if we bought that site today, they'd probably put a six-pack on it, but there's 3 villas on it, 4 villas on it. They've got a little courtyard. It's just like a small house. And I think they're really underrated at the moment, particularly in Melbourne. In Brisbane and Sydney, well, you'll get a double garage in Sydney, but in Brisbane, you're probably getting an apartment that's probably slightly overpriced in getting to the top of the market.
Well, villa units were built in the 60s and 70s for older retirees, but nowadays they're very much appreciated by young families because they're big apartments, but without anybody above you or below you. You've got your land component, which is part of our seven-stranded approach, and you're in a great location. So the location is important. So I own a lot of villa units. I know you do as well, and they're really good, strong investments, and they grow more like houses with regard to capital growth, and they're always easily rented out by young families, by older people who are looking just for safety and security and something small without neighbours all over them. So that's a really good entry point in Melbourne, and it's the way people like living in Melbourne. It's not the way that people live in other states, is it?
Yeah, and we can also get a house in Melbourne, Michael, around that 800 mark. We can't get anything like that in Sydney or Brisbane, like a house. So there's a little pocket there we've found. We stumbled across it because a lot of our home buyer clients were buying there, and we looked at the demographics, we looked at what was going on in the area, and took a step back and said, hang on a minute, this is a great little pocket here. So we're getting a lot of really good properties into that market as well.
Well, even in the 600s, there are homes that were first home buyer homes a while ago, but it's an area that's gentrifying in the southeastern suburbs. And it's an area where a number of the people who used to live in apartments now want to have land, want to have 3-4 bedrooms or 2-3 bedrooms and a study. But it's also important to have great public transport, great shops, great amenities. And so, yes, interestingly, in Melbourne, you can buy a house and land not very far from the water, cheaper than you can buy an apartment in Sydney.
It's amazing, isn't it? Sydney's a great opportunity for investors who are maybe considering purchasing in super. Obviously, we can't get super advice, but we've helped clients who have got that legal advice, and we've put them into, I guess, apartments in the eastern suburbs or the inner west, depending on your budget. And they're just super low maintenance. They tick all the boxes. They're nice and large. They're very, very, very low maintenance. And they've also got a very good rental return, Michael. So for something in super, Sydney's a really, really good option to get in there as well.
I've seen some of the apartments that Kylie, one of our buyers agents in Sydney, has been buying, seen the floor plans, seen the views. To be fair, I haven't seen them personally, but I know you vet every property. So there's a process at Metropole that the buyers agents just don't buy something. There's a process that has got to tick all the tick boxes, and then you or Leanne actually check it, double check it before it's put to a client. And I've seen some of those great apartments that we've been buying in Sydney, the new round of apartments are going to cost 40% or so more. So there's great inbuilt value. And I think that's one of the benefits of using a buyer's agent, that you don't actually have to buy in your own backyard. A buyer's agent saves you time, minimises your stress, stops you getting emotional about properties, and it does give you a range of an opportunity to access to a wider range of properties, either in your own state or in other states. But I think one of the benefits our clients have found, we've known for a long time, is that they're expert negotiators. People get emotional, and when they find a property they like, selling agents are trained professional negotiators. They have training every week on that, and you're basically shark bait if you try and do it on your own, Brett.
It's really interesting. It's also the language that they use. And, I guess they cut the BS when they're working with us, and they know we've used that language. And so we cut to the trace straight away, and we can't be kind of a pushover or a sucker for coming up with more money and things like that as well. So it's been very, very valuable to have, I guess, someone who speaks their language on their side. That's for sure.
Well, that's right. I mean, I know that a selling agent knows 5 things about the property that you should know, but they're not going to tell you about. And so we actually understand what to look for. The other interesting thing is that in each state, the disclosure that vendors have to give is different. In fact, in each state, the way you buy properties is different, with cooling off periods, when you do your due diligence, how you do your due diligence. So having an expert buyer on your side, not one who flies in and flies out, one who knows the market. And that's why we have our own team of experienced, most of them are ex-selling agents, so they know the game well. Of course, at Metropole, we're much, much more than just another buyer's agent. While our buyer's agents will help you find the right property and help you choose the right property and avoid the common mistakes, we also, as Brett's already explained, start by putting a plan together, and then we'll help you get the right ownership structures, sort out the right finance to get you the maximum that you can safely, not just buy a property, but buy time in case the market moves up, moves down, interest rates don't go down as quickly as we like. So we always make sure our clients have the right finance buffers. And then we'll help you in the long term with property management. We'll keep annual review checks on you to make sure it's going well. So we're much, much more than another buyer's agent. And if you'd just like to understand how you can make 2025 a great year for you in property, why not have a wealth discovery chat with one of our wealth strategists? Just go to metropole.com.au. I'll leave the link in the show note, but have a chat with one of our team to understand how our services could help you. And if not, no problem at all. You'll probably still get a free copy of one of my books for even just having a chat with our wealth strategists, metropole.com.au. So we talked a bit about villa units in Melbourne, Brett.
Yep.
We talked about homes in Melbourne that we've been buying, and they're doing very, very well. They're very lettable. Apartments in Sydney are great investments. Who wouldn't have liked to buy? When we first started buying apartments in Sydney in 2008, we were buying in the inner west in Marrickville apartments for $280,000, Brett, that today'd be worth close to $1 million.
Absolutely.
What other price points and what other properties would you be buying?
Once you start getting north of 850, I mean, Brisbane's a good opportunity to get a house. I think, you're still getting within that 10 or 12 Ks. I mean, that's going to be great for the Olympics rolling around. There'll probably be a period of time between then and there where the market will flatten out. Also, development sites that, once we get people with budgets of, 1.5 as a 2 million as a purchase price, we're kind of putting them into good development sites in either Brisbane or Melbourne, in those more affluent southeast locations in Melbourne and the good locations in Brisbane. And
I'll just interrupt there for a sec.
Yeah.
So the concept is, it's not a development site, it's an old house with development potential. I'm not wanting to, it is for development, and we can manage the whole process from concept to completion. But this starts with the plan. Have you got the budget? Have you got the ability to complete it? Does it get you faster, quicker to where you want to be, but safely? Have you got the resilience to do it? Because a development isn't necessarily right for beginning investors. We like people to have been through a cycle or so and understood the ups and downs of the market. But then Greg and our development team are going to take you through the whole process from beginning to end, allowing you to become an armchair developer and end up with 2 nice townhouses or 2 homes on a block where there was one before. So you get manufacture capital growth, you manufacture rental returns, you get great depreciation. And interestingly, despite the extra debt that you need for that, most of them end up being cash flow neutral at the end because you're basically buying at the wholesale end of the market. Boy, it's a great way to grow your wealth faster and safer.
Yeah.
I know at Wealth Retreat, Greg and I are going to spend some time talking through the development process, showing people feasibilities, getting them to understand if development's right for them. So if you want to make 2025, actually the next 5 years of your life, the best 5 years of your investment life, have a look at the website at wealthretreat.com.au and join Brett, me, Mark Creedon, Ken Race, Simon Kirstenmacher for this annual event that we hold. It's a small group where you're going to become part of a community of already successful investors. Don't count yourself out. Go to wealthretreat.com.au. Sorry, Brett, a shameless plug there. But people interested in development will understand from Ken about the structuring and from our finance strategist about the finance that's involved. It'll actually, Wealth Retreat will help them. But you don't have to go to Wealth Retreat to do that. Just have a chat with our wealth strategists.
Yeah, well,
we
another
also
quick
have
plug
got a
there.
number of very high net worth clients that we help as well, Brett. If somebody's got even more than that, what will we be offering them?
Yeah, look, I mean, we're getting some great opportunities in Melbourne around that $3 or $4 million mark. We talked about, below replacement cost and intrinsic value, something with a twist. I mean, we picked up an amazing block of units in the early threes, didn't we, for a client down there in Melbourne. The lovely thing about it was close to the water in a good suburb. I think it was a 4-pack, Michael. It was actually Art Deco, which is the twist. They're very, very, very highly sought after. And once we did the numbers, you could just see how far below replacement cost it actually was.
Well, when you look at the council valuation and you see what the council land is, and then you see that it didn't cost much more at the moment because apartments in Melbourne haven't performed strongly. So therefore the client was able to buy considerably below replacement cost. It's something they couldn't replace because you can't replace Art Deco, the style, the character, and good rents. And as you say, the suburb, let's be blunt, close to the water, close to St Kilda, shopping centres, Ackland Street. And there's another client we're currently looking for with an even bigger budget. There's a few good apartment blocks available, not many. There's a few dud ones as well.
Yeah.
So I guess we can help people from $500,000 to $4 or $5 million, but we're also helping people with commercial property. But it's got to be at the right stage of their cycle. And that's where the strategic plan comes in. Because if a lot of people are keen because of the podcasts and the webinars to buy commercial, and in my mind, too early in their cycle, because when the property wealth planners actually put a plan in and show you buy commercial property now, yes, it'll give you more cash flow, but it's not going to give you the capital growth to get the next one and the next one. So commercial properties are great, but they've got to fit in at the right part of your journey, Brett.
Yeah, 100%. And also with, I guess, different levels of commercial properties as well. You want to get into the more secure tenancies and flagship tenants and things like that as well, rather than the mum and dad investors where it's quite volatile as well. So there's a lot to consider in that space.
Very much so. So again, I'd be only investing in commercial property in the capital cities. I know people are buying in regional areas and there are some opportunities there, but we don't fight the big gorillas. Why take a risk when we know that moving forward over the next couple of decades, your property is going to eventually be the way that you live off. You're wanting to build an asset base that gives you cash flow. And so you should be investing where the main economic drivers, social drivers, population growth is going to be, and that'll be in our capital cities, not in regional markets, Brett.
Yes, well said. And I think this is the year now where it's all going to change and all going to shift, because most of those markets are going to run out of steam with affordability and serviceability and things like that as well. An interest rate cut may delay things a little bit longer, but I think it's time to get back to basics. And as you said, follow the big trends.
Well, interestingly, again, having a long-term focus as well, because if you think about it, many of our people listening to this and a lot of the clients at Metropole are wanting to retire in 10, 15 years' time, and then they're going to be in retirement for 25 years or so, and then they're going to want to pass that property on to their future generations as well, or those properties. It should be more than one, of course. And so therefore, it's got to be the sort of property that's going to be in continuous strong demand and outperform over the next 30, 40, 50 years, not what's sexy or trendy today, Brett.
No, and I think that's the biggest pitfall for a lot of investors. They're probably thinking about the next year or two rather than probably a decade or two ahead. And if they shift their thinking, they'll grow considerable wealth.
Well, I guess what we started to say was we're going to explain the sort of properties we're buying, but I'm glad we actually dug deeper to understand the theory behind it, because property investment is a process. It's not an event. Looking on the internet, going to open for inspections isn't research. And while we've got all the data looking back, everyone's got access to that. We've got proprietary data looking forward, and working with people like Simon Kirstenmacher and Andrew Wilson and our own teams involved as well, means that we're actually not looking in the rear vision mirror. That shows where the market has been. We want to understand where the market's going and having a big picture view. Brett, thank you very much. I think that's given us, our viewers, our listeners, a good insight. And I just like to remind them that this is going to be a good year. Don't get scared by all the negative media, because there is going to be a lot over 2025, especially the first half, until interest rates fall and until the election happens. But why not get your ducks in a row so that when interest rates start to fall, when the market starts to improve, you're ready to go. In fact, in my suggestion, you should be getting going before the crowd, Brett.
Michael, I don't like waiting in line, so I prefer to be prepared and I can take action rather than getting to that point and then having to go back through everything. So I think it's a great time just to get your ducks in a row. Doesn't mean you have to push play, but get yourself into a position to take action when you're comfortable.
Fantastic. Thanks for your time, Brett. Look forward to catching up with you again next week.
Thanks, Michael. Good to be with you again.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to share one of my favourite fables with you. It actually is a powerful lesson in life. It's about a man, a boy, and his donkey. When something like this, a man and his son were going with their donkey to the market, and as they're walking alongside, side by side, a countryman passed them and said, "You fools! What's a donkey for but to ride on?" So the man put the boy on the donkey and they went on their way. But soon they passed a group of men, and one of them said, "See that lazy youngster? He lets his father walk while he rides." So the man ordered his son off the donkey and got on himself. But they didn't get very far when they passed two women. One of them said, "Shame on that lazy lout letting his poor son trudge along." So the man took the boy on top of the donkey. They both rode the donkey, and they got into the town. And all of a sudden, people started to jeer at them and point at them. "Aren't you ashamed of yourself for overloading that poor donkey?" people were saying. So the man and the boy got off and tried to think what to do. They thought and they thought. At last, they got an idea. They cut down a pole, tied the donkey's feet to it, raised the pole and the donkey on their shoulder, and they actually carried their donkey along. They went along, and all of a sudden there was laughter. Everyone who saw them was laughing at them. And then they came to a bridge when the donkey kicked loose, fell over the side and drowned. "That'll teach you," said the old man who followed them. "Please everybody and you'll please none." Well, that's actually a little fable, but I guess what I'm wanting to get across to you in my mindset message today is that at every step of your journey, there are people who are going to feel the need to voice their opinion about what you're doing or what you're planning to do or your vision or your goals. They're going to say it makes no sense. They're going to laugh that you're on the wrong path. They're going to tell you to be more realistic. They're going to question every move. So when that happens, I want you to remember this fable. If you listen to everyone, if you try to please everyone, you're going to please no one. So my mindset message to you today is stop worrying about what others think. Do you. Be yourself and live according to your values. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?